The stock market has been correcting quite significantly recently, with bond yields dropping sharply and commodity prices also falling, some even breaking down. The yield spread between high-yield bonds and treasury bonds is widening, signaling growing fear in the markets across multiple indicators. We have a perspective on this situation, and if you been following, this may sound familiar. This is a case of slowly, then all at once. We have been discussing a rolling recession that has been unfolding since the Fed began raising rates in 2022. The impact was immediate. Housing effectively entered a recession as soon as rates started to climb, and commercial real estate, particularly office spaces, was already in a downturn. This slow unraveling is now accelerating, and the signs are becoming more evident across various sectors of the market.
The stock market has been undergoing a significant correction recently, with bond yields dropping sharply and commodity prices falling, some even breaking down entirely. We're also seeing the yield spread between high-yield bonds and treasury bonds widen, indicating growing fear and uncertainty in the markets. These shifts in various indicators suggest that the market is increasingly on edge. This situation aligns with a perspective we've discussed before, the idea of slowly. Then all at once we have been observing a rolling recession that began as soon as the Fed started raising rates in 2022. The impact was immediate. Housing essentially entered a recession right away, and commercial real estate, particularly in the office sector, was already struggling. As the Fed's rate hikes have continued, the effects have continued. The effects have gradually spread across different sectors of the economy. What started as a slow and controlled downturn is now accelerating, with signs of stress becoming more evident. The correction we are seeing in the stock market is a reflection of these deeper issues, as the economic slowdown broadens and intensifies.
Subscribe our channel and press the bell button to get our video notification. And like the video.
The world seemed to be moving in one direction, but suddenly things have shifted dramatically. One topic you'll likely hear more about in the news is the unwinding of the yen carry trade. This involves investors and speculators who borrowed yen due to Japan's historically low interest rates, which were much lower than those in other parts of the world. They borrowed yen, effectively shorting it, and then redeployed those funds into dollar-based assets or other currencies, primarily into U.S. Treasury bonds, which offered higher yields. Since 2011, the yen has either been stable or depreciating, making this trade relatively safe. If the yen depreciated further, those involved in the carry trade would benefit from both the currency movement and the higher interest rates in the U.S. Some speculate that part of this trade involved borrowing yen and investing in the Mag 6 tech stocks or broad-based U.S. benchmarks like the S&P 500 or NASDAQ 100, both heavily weighted with these large tech companies. While the exact scale of this carry trade is uncertain, a Deutsche Bank study suggested it could be as large as $2 trillion. To put that in perspective, the U.S.
The world has been operating under certain financial assumptions for years, but recent developments have turned those expectations upside down. One of the most significant shifts we're witnessing is the unwinding of the yen carry trade, a complex financial strategy that has been quietly but profoundly influencing global markets. To understand this, let's break down what the carry trade is. Essentially, the carry trade involves investors borrowing money in a currency with very low interest rates in this case, the Japanese yen, and then using that borrowed money to invest in higher yielding assets elsewhere, often in US. Dollar-based investments like treasury bonds. The idea is simple: borrow cheap, invest where returns are higher, and pocket the difference. This strategy has been particularly attractive because Japan's interest rates have been near zero for years, making the yen a popular currency to borrow. Since 2011, the yen has either been depreciating or remained relatively stable. This stability made the carry trade seem almost risk-free. If the yen stayed the same or lost value, investors not only earned higher returns from their investments in the US. but also benefited from the favorable exchange rates when paying back their yen-denominated loans. This dynamic made shorting the yen a key part of the carry trade an attractive bet. But why does this matter now? The scale of this carry trade is enormous. Some estimates, such as a study by Deutsche Bank, suggest that the total value of these trades could be as high as $2 trillion. To put that into perspective, the entire US economy, measured by GDP, is about $25 trillion. So a $2 trillion carry trade represents a significant chunk of capital that has been flowing into global markets, particularly into US assets. If this estimate is accurate, it means that a large portion of global financial activity has been influenced by this trade.
The situation unfolding in the United States could offer some valuable insights since around 2010 or 2011, following the 2008-09 financial crisis, we've seen significant growth in both the yen carry trade and in the private equity and private credit markets. In a low interest rate environment, there was a strong reach for yield, particularly in the multifamily real estate sector, where rents were solid and returns were leveraged up. This buildup in debt, especially in private equity and private credit, is something we're closely monitoring. Unlike the subprime mortgage crisis of 2008-09, where risky mortgages were packaged into AA-rated securities that eventually triggered a massive financial meltdown, we don't anticipate a similar systemic risk here. The current concerns seem more focused on specific sectors like commercial real estate. To draw a parallel, back in 1986, changes in tax laws removed the tax shelter status of real estate, which severely impacted commercial real estate but left the broader economy relatively untouched. We're seeing something similar now, as certain trades might unwind and some sectors could face challenges, but we don't foresee a widespread financial crisis.
The unfolding situation in the United States could provide valuable insights, particularly as we look back at trends since the 2008-09 financial crisis. Around 2010 to 2011, we saw significant growth in both the yen carry trade and private equity and private credit markets. In the context of a low interest rate environment, there was a notable reach for yield, especially in the multifamily real estate sector, where solid rents and leveraged returns attracted substantial investment. This buildup in debt, especially within private equity and private credit, is something we're keeping a close eye on. Unlike the 2008-09 crisis, where risky subprime mortgages were packaged into AA-rated securities and led to a massive financial meltdown, we don't see a similar systemic risk this time. The current concerns are more sector-specific, particularly in commercial real estate. A historical parallel can be drawn to 1986, when changes in tax laws removed the tax shelter status of real estate, significantly impacting commercial real estate while leaving the broader economy relatively unscathed. We're witnessing a similar scenario now. Certain trades might unwind, and some sectors may face challenges, but a widespread financial crisis seems unlikely. Deflationary pressures, prices dropping across various sectors are something unusual and worth monitoring. While we don't anticipate a repeat of 2008, the gradual unwinding of specific trades could still have significant implications, particularly as deflation starts to take hold in certain areas.
Subscribe our channel and press the bell button to get our video notification. And like the video.